All right, so you say there's much more here. Something you're focused on is a term I actually haven't heard before, debt sustainability, and how that should factor into allocation. So, the U.S. has the most robust government debt situation in the entire world. How sustainable is it?
Well, frankly, in the US, debt sustainability has become almost this mythical creature where we all know the risks, we've all heard the cautionary tales, and yet there have been no systemic sustained consequences for the US running higher and higher debt levels and the efficiency of that spending declining over time. I think some of this is quite valid, primarily because we haven't seen a developed economy default on its debt since the Second World War. But even if outright external default risk isn't the key risk around debt sustainability for the US, I think that tells investors not to ignore it, as many have been, but that it's more in the journey rather than the destination. And my research has been focusing on what investors can do in that interim debt management point between today and any potential sort of crisis point.
Wait, potential crisis point. So just to be clear, our debt is in U.S. dollars. We can simply print the dollars, so we can always pay the debt. But you're saying it will reduce potentially confidence in U.S. debt. So one other theme that you've been looking at is also protection and promotion of debt demand. Something that a lot of people are talking about is, again, this big, beautiful bill. How does the big, beautiful bill potentially impact our debt demand?
Well, ultimately, that's going to be up for the Senate and the bond market to decide. And it is very clear that adding in this pace to our deficits is not considered a step toward more sustainable debt. What I think is most important to understand about the U.S. debt load is exactly what you said, that we can always, in theory, print more dollars to service that debt. So it's not about default risk. We do, however, have to address the very near-term Achilles heel, if you will, in the U.S., which is our interest payments. Now the U.S. is spending more on interest payments than on defense. It's beginning to crowd out discretionary spending. And I don't think making adjustments there needs to be a traumatic event for the markets. I think it can be signaled with a very gradual glide path on deficit spending.
All right. So one of the issues that you're talking about here is our interest expense. It continues to grow, and obviously if yields go higher, that increases the interest expense. Another issue that seems to be playing out right now is, I guess, a shift away from U.S. exceptionalism, certainly in the currency market, but is that something that we may see also in the debt market? Is that a real concern, at least in the near term for the U.S.? Obviously long term, nobody knows, but in the near term, are we going to see people go to gilts or German bunds?
Unfortunately, there's really no alternative at scale for U.S. assets. And whether that's unfortunate or not, I guess, depends on where you sit as an investor. But let's think about Europe, for example, as an alternative to the U.S. when it comes to debt assets or even equities or other asset classes. Europe does not have integrated capital markets. And so that is the big hindrance to Europe replacing the U.S. or serving even as a viable alternative. We could also look further afield to China, which theoretically does have the scale, but it also has a closed capital account. And we do not see any willingness for China to open up that capital account and to integrate and liberalize its capital markets. So in the meantime, and that might be the next 50 years, the U.S. is the only integrated at-scale, deep and liquid capital market to play in.
You know, Julia, I know a lot of your research, at least in this instance, is really focused on some of the issues, but I do have to ask, is U.S. debt attractive right now, at least at the short term? I mean, rates are pretty elevated. They pulled back after that ADP report, but you look at the 2-year, just a day or two ago, was up about 4%. I mean, isn't that relatively attractive for investors?
You know, I think that the overall theme that matters most for me and my team right now is the overall volatility across the curve. It means that duration is not our preferred place to take risk right now. And on corporate credit and credit more broadly, we are staying slightly shorter duration. In our view, that's a potential solve for two issues. Number one, the yield volatility, and number two, any potential credit quality concerns that might come up in the corporate market as the economy slows per our expectations.